Hi, I'm Len Adams.
I'm Justin Gross.
Welcome to our third quarter edition of our Video Insight, our client conference call. Appreciate you taking out time today to look at this presentation as we try to give you an update on the markets and investment strategies we're working with at this time. As we get started on our call, it's important to note that everything we talk about is really for educational purposes only. Nothing here is intended to be financial advice, and for specific advice, obviously you want to talk with your advisor. And we're members of Cetera Advisor Network, which is also important to note. Okay, year to date, just worth mentioning, how are we doing? How's the world markets doing? So if you look at your slide deck, for those that got this ahead of time, you can kind of see that as of the end of June, the way that things are laid out is the small company stocks have had the best run year to date, up 7.7%. The U.S. large companies, as measured by the S&P 500, have also had a pretty good run. They're up 2.6%. And then the hedged assets is up 1.4%. Commodities are flat, and bonds and international are negative as of the end of the second quarter. Probably the biggest story for the year so far has really been around the international marketplace. Trade wars, things of that nature, a lot of pressure on emerging markets, and just sort of the fate of how will globalization be affected by trade negotiations, and it's reflected in the returns this year.
Yes, certainly reflected in the international performance, but also maybe back to domestic with small companies not being as globally affected domestically.
Right.
And still technology, which is not really referenced here, but continues to lead the way.
Another thing that I think is challenging for people to get their arms around is that bonds have been negative all year to varying degrees. As of the end of the quarter, they were down 1.6. Today, they might be down around 1 because we have had a pretty good move in bonds in the last 10 days. But when you have a rising interest rate environment, the expectation would be that bonds are going to lag on a total return standpoint. So not to say you shouldn't own them, but they've been dragging this year. So here's the 4 questions that we seem to be getting a lot. We really want to focus this call on these 4 questions, right? So is the U.S. economy getting better, getting worse? When we get the next recession, what will it look like? Is this a good time to buy stocks, to invest in U.S. companies? And what is going on in the international market? Should we still be investing there? Those are the 4 big questions that we're getting pretty regularly. So we thought we'd just kind of hit those head on in our call today and take you through a few of those items. When we talk about economic growth, when we're thinking about the notion of, is this a healthy environment? If you look at the slide deck, you'll see that we're at 15 consecutive quarters of economic growth in terms of earnings growth with U.S. corporations. And as Justin mentioned, a lot of that is technology driven, and that's really the function of just companies trying to do more with less workers, so technology can give you more productivity. And it's just been a recovering of consumer confidence, right? People are spending more money, people are buying new houses, buying new cars, spending money, not quite so fearful that things are going to get bad. However, if you look forward, what the analysts project for the next 4 quarters, you will see that there's a slight decay on the horizon, and that's where basically you have some of the federal stimulus money fall off. We anticipate the Federal Reserve to raise rates another 4 times in the next year, and then we also have a very, very slow growth workforce. So you run out of workers at some point, right?
Yeah.
So,
I mean, putting this back into market performance perspective, I mean, this can continue for some time. It could turn around. The thing I love about our current strategy with our defined risk strategy is we don't have to necessarily call that and make a forward-looking decision. We can wait and see and let that play out. So,
yeah. So for the time being, things do look good. I mean, this is probably one of the best earnings environments we've seen in many decades. So I think that's a good thing for the markets. Another piece of the economy is the job front, and I'm not sure that everybody realizes it, but we're at a 50-year low for unemployment, and that is a intentional outcome from some of the political structure, creating tariffs to import goods, focusing on the labor markets at home. It's a function of having a shrinking workforce, the quantity of workers. But we're now at a 50-year low at this current rate. The anticipation is that by next year we'll be at a 70-year low in unemployment. So if you want a job, you can pretty much get a job nowadays. So let's talk about recession, because that's a question that comes up a lot. Well, it's been going up for a long time. What's the next pullback? What's the next recession? And it's really important that people understand that a recession isn't necessarily a bad thing for investors. I mean, you can go back and look at, we've had 11 recessions since World War II, and in all of those recessions, there are segments of the investment world that didn't lose money. They actually performed well, made investors money in those periods of time. It's really about being able to remain flexible with what you invest in and how you navigate that, and being smart about your investment selection. If you're buying stocks of companies that require fast growth for them to grow their earnings and grow their sales, and things turn the other direction, well, that wouldn't be the type of stock or type of company you want to own. But if you own more defensive brands, things that have dividends, things that people tend to buy when it's stormy weather, if you will, in the global economic landscape, those types of things tend to do better when you have recessionary environments. So recession doesn't mean that you're going to lose a bunch of money. It could mean that. It's how you're positioned, but it does just mean a sort of a period of time where the excesses get worked off, and you have to get leaner to move forward. But I do think the key drivers of recession that we would see from this point is, the Fed is raising rates. They have to raise rates. We're trying to normalize rates so that the interest rates that savers get on their savings is a number that is historically normal. It's still way below average. As rates go up, the cost to own a home goes up. The cost to buy a car goes up. Anything that you finance becomes more expensive. Again, not having a labor pool that is growing creates a real challenge because there's not enough workers. As the economy heats up and there's not enough workers, it's going to make prices go up. That can create some recessionary issues. There won't be enough cooks to cook at the restaurants. There won't be enough carpenters to build the new houses, and so prices can go up. That creates some recessionary pressure. And then, just the ebbs and flows of the federal stimulus money wearing off. The government passed an incredible spending bill 2 years ago. Some of those incentives taper off at the end of next year. So I don't think we have to be terribly fearful, but it is something that we have to be mindful of, that when we get a recession, we just need to be adjusting. And of course, the defined risk strategy that we use does that automatically. If you move below the 200-day moving average, we make changes in sectors.
Yeah, and it's important to understand that it's a normal thing. It's the cyclical nature of business and economies, and I think where people get in trouble is when they're not prepared.
Right.
If you're prepared and understand that, going into it, have a strategy, you're not making knee-jerk reactions in the middle of volatile times if it's related back to declining stock prices. Having a strategy in place before it happens, you can sit and we can wait on it.
Right. And the cyclical nature comment, one strategy we know does not work. And that is, and this happens a lot of times in the 401k world, here's your choices. You got 20 different choices. These 5 just made incredible returns. I'm going to go buy those 5, right? If you are investing in the things that just made a lot of money, as the cycle changes, that's the pieces that get hurt the most.
Right.
And a lot of people don't see that coming, and that's where people get hurt in recessions. So obviously that's not how we manage money, but a lot of people get caught into that trap.
But recession, going back one last point on that, to stock performance can be a tremendous opportunity.
It can be.
If you protect
right.
and are able to reinvest lower. So
that's true. That's true.
Not always a bad thing.
So another question is, is right now a good time to own stocks? Obviously market's at an all-time high. Earnings are at all-time highs. Some might say, well, it just can't get any better than this, right? This is showing that, okay, yes, stock prices are at an all-time high, but earnings, consumption, growth, demand, all of these things are a function of global population, global wealth, and they are at an all-time high. The key measure is on the right where it says global valuations, and you'll notice that U.S. stocks today are selling at 16.3 times their annual earnings. And then that little band that shows you from 10 times to 25 times is sort of the range that stocks have sold as a multiple of earnings over the years. We're right in the middle. So from an investment standpoint, I don't think we're paying excessive amounts of money to buy stocks at these prices relative to their earnings. Certainly not on a historical basis, it's been a lot higher. And I think that if earnings do continue to improve and the results of the trade imbalances and the political processes yield more earnings for American companies, I think you want to be invested here. I think this is an opportunity for you to make more money here than you can in interest-bearing instruments or at the bank, or certainly sticking the money under the mattress, that kind of thing. So the key, as Justin mentioned, is if you're going to be invested in stocks here, you have to know what is the exit strategy, what is the plan if things begin to move in a direction that's not favorable. Also on this slide, worth mentioning, the Europe region, the emerging markets, the Japanese, all of these are selling under historical norms from a valuation standpoint. So someone could easily say, hey, those are cheaper, why don't we buy those? But again, when there's pressure, when there's turmoil about policy and trades and diplomatic relationships that are questioned, that is creating a flight to quality, or flight to safety, as people might call it. And the U.S. still is the largest operating economy in the world. The U.S. today produces about 53% of the world's total economy. So those valuations, I think, are suppressed in the backdrop of some of the political drama that's going on. It may stay that way for a while, hard to know.
And they have been for a while.
Well, that's true.
They have been, and ultimately at some point in the future, anything, if you wait long enough, will rise back up. Reversion to the mean we know is a true thing. So we want to be able to have exposure to those when that time comes, but it's been that way for a while.
Yeah, and we got out of international. We participated last year pretty well, and then we saw international move below its 200-day average actually this quarter, so we shifted out of international this quarter. And if international finds a bottom and then kind of begins to move back higher above its 200-day moving average, we'll re-enter, because the valuations are great, but we're not interested in being a part of a sector that's sort of in a chaos mode.
Right.
Another thing that's important to look at, especially in terms of owning stocks, one of the best leading indicators of all the indicators out there is the purchasing managers index. The companies are manufacturing, they're getting orders for goods, so they buy raw materials, and they can track that. And this heat map shows you that in the last 10 years, we're at the best moment in time in terms of just pure manufacturing orders, capacity, the purchasing of raw materials. So we think that there's a lot of reason to believe that the global economy is still in very good shape and continue to improve over the next few years. But we may have some slowdowns. I'm thinking we're probably going to see some slowdowns in 19 or 20 with the reasons we mentioned earlier. But right now, things are looking pretty good. On the international front, one other thing that's worth mentioning, because I like international. I mean, if you own international stocks structurally for the last 25 years, you've outperformed the U.S. The problem is that in the last 10 years, you haven't, right?
Right.
The valuations on international are really substantially more attractive. It's selling at 13 times earnings. The dividend yield overseas is typically going to be in the 3 range versus here it's under 2. But you want to own international when the environment is right for international to flourish. And this just, with the political pressure and the trade wars, I don't think is quite the right environment. But we will want to come back to it. This graph shows you in terms of recovery from the Great Recession, international is only up 115% versus the U.S. markets are up 300%. So there's certainly more room for it to catch up, but you got to get the public eye focused on international earnings, not international politics.
Right.
So just another plug on the defined risk strategy. We are out of international at the moment because those stocks did move under the 200-day moving average. We shifted a large part of the international stock to U.S. and in the more conservative portfolios, we went to short-term U.S. credit. both of those moves in the last month have turned out to be good, so far. When international finds a bottom and surpasses its 200-day moving average, we'll look to re-enter again. Hopefully, we'll re-enter at a lower price than we were able to come out and pick up more shares for our clients as we do that. So the only other thing I really wanted to mention, sort of as a final thought, is, we did a presentation last year on Trumponomics. And, we talked about President Trump has a different view of the way that the economy works, the way that we can combat unemployment, the way that we can drive our economy to higher high than prior politicians. And to some degree, a little bit more radical in the way that he wants to get it done. But if you didn't see the Trumponomics presentation, I think it would be really good for you to go back and look at it, because some of the things we're seeing happening right now, we talked about that in that presentation, and some of the data that we're seeing in jobs and wages and the economic improvement. We hinted at that in that presentation, and I think a lot of people, they just don't understand the macros of what he's doing enough to realize that economic growth is the intended outcome. And on the China thing, interestingly, the Chinese for the last 30 years have had the fastest growing economy of all economies, right? But the way that their political policy has been is that the only thing that matters first, second, and third, and fourth, and fifth is jobs. Like, they want Chinese workers working. And if you've ever met anyone that's worked in China, they will tell you they work like no other, right? A lot of what the policy that is being dictated right now around this trade policy is about creating American jobs and creating an environment where there's wage pressure, where the people that have chosen not to work, they've chosen to maybe live on less, will have a bigger incentive to get back into the workforce. And the data that's really interesting is it's the workforce capacity. There's 62% of the American workforce was employed recently, and 38% were not interested in working, according to certain statistics. And that number is improving because of this work tariff trade situation. So if you didn't see Trumponomics, you should go back and look at it to kind of get a bearing on what's going on. We're going to navigate the stock realm and the bonds and keep the portfolios balanced and try to grow. Don't anticipate a bad finish to the year. In fact, probably better than most people expect. Anything else you want to add?
Markets are volatile. Political figures are sometimes volatile. The market will figure it out. It's a great method of separating things and coming with an equilibrium price. So that's what markets do. International, domestic, we want to be there. I think the defined risk strategy, it's a fantastic time to employ that in a volatile time. Try to be there for the highs and capitalize on any potential lows or recessionary pressure. So that's it.
Well, we're here if you need us. We appreciate the opportunity to serve you and your families. It's the summer doldrums, as they call it. So things get exciting. We'll be here ready to make whatever adjustments as needed. And with that, we'll wrap up, and Justin can take you through the final disclosures.
Keep in mind that while diversification may help reduce volatility and risk, it does not guarantee future performance.
All economic and performance information is historical and should not be considered indicative of future results. Investments in securities do not offer a fixed rate of return. Principal yield and/or share prices will fluctuate with changes in market conditions, and when sold or redeemed, you may receive more or less than originally invested. These views are those of Adams Financial Partners and should not be construed as investment advice. All information is believed to be from reliable sources. However, you make no representation as to its completeness or accuracy. Consult your financial advisor for more information.